Okay, this is going to be my last video of the day. I'm a little tired. This is another one of the videos that goes through problems with the IRR. And in this particular problem that I want to demonstrate is when you have a high credit spread, like your friends at the IFC, Division of the World Bank. I saw recently they want to charge on mezzanine debt, they wanted to get a 22% return. I think on the debt itself, they wanted a credit spread of something like on the senior debt 6%. When there was there was an enormous PLCR and a pretty good LLCR. So let's put some debt here, and this really gets into the whole business of charging high credit spreads and high risk premiums, particular to developing countries. Okay, I'm not talking about Greece. I understand that you might want a high risk premium there, obviously, with a very high chance of default. I'm talking about a PPA project in Nigeria where the government of Nigeria has put up a letter of credit to protect all the PPAs, and they still get these enormous 23 kind of percent returns, and debt of maybe credit spreads of 7, 8, 9, 10%. Okay, so let's put a risk-free rate. Okay, and let's say the risk-free rate is 2%. How about, because it's we've got a credit spread, a credit spread rather, an interest rate swap. So, and where is my generic macro file? Here it is. And by the way, why don't we just open a file in chapter 1? I'm not copying files for a class right now. In chapter 1, let's go to the data retrieval, and let's understand some interest rate issues, okay? And so I'm not suggesting that, that I have a better answer. So if here's a double B credit spread, which is in the neighborhood of 6%, a single B credit spread rather. Double B credit spread. Do I have the formulas turned off? No. What is that in the neighborhood of 4%? Single B credit spreads. I'm sorry, triple B credit spread of down there at 2%, and triple A credit spread of down there 1%. So you can look at all those, and if we want to make a double graph, we could here's the single B versus the triple B interest spreads much higher. Of course, they went way up during the financial crisis. So what does a double B credit spread really mean for a project finance that has a long-term tenor? Okay, that's kind of the thing we're doing here. So we can put a spread now of 2% and see what happens when it's the risk-free rate rather of 2%. I'm sorry, if we oops, that's how you make the graphs. If we look at where's it, 10-year swap rate, what is that? That's somewhere around 2%. I hate this thing. If you want to, switch make the spread, make that scale different, you can do that. So what's our credit spread now? You can see it's just around 2% for 10-year. Okay. Come on. There we go. Suppose I could put more things into this interest rate thing. Maybe I'll do that. I'm kind of liking that one. And then let's put a credit spread. Okay, and let's make the credit spread 1.5%, which is kind of a number that's like a long-term number for project finance. Okay, and what we want to do is kind of understand what's the implied probability in this. And let's put a tenor of the debt in. Let's make the tenor 10 years. Okay, whoops, what happened there? Tenor 10 years. And then we'll just make a regular old payment. Okay, so I hope this will be okay. So let's put the period number here. And start with 1. We'll go up to 30. Alt EIS, tab 30, enter. And we can make the payment period. Okay, we'll leave a 0 out. You know, I didn't leave. Maybe I'll better get a couple extra lines here. So PMT of the, now let's put the rate here. And I think we have to put the risk-free rate plus 1 times 1 plus the tenor. So it's not like you're adding it in a normal bond agreement. Minus 1 to make the mathematics work. So the total interest here is this, and we put PMT, and we put the rate, and we put the payment, cash flow. We need to put the payment period. Okay, and then we put an equal sign and make this less than or equal to the 10 and press the F4 button. Okay. And then the payment is the rate and the number of periods, which is the tenor, and a minus on the present value of the bond. And we'll multiply that by the true or false. Okay. And we'll put a minus on the bond, and we'll put the IRR on the debt that we get. And that's the same as what we used in the payment, which is supposed to be. Now, the question is, out of that debt, how much is the default, and what's the real value of that default? And that's where the mathematics, and that's where things get tricky, because if the credit spread is 5%, then we get a higher payment, and that 5% allows a much bigger default. If it's 10%, that's really high. And then we get this, so we can you can kind of see how much there's going to be default. I'm going to put 4% for now, just to make it a little more dramatic. Now, to let's compute the implied default. Okay, I think, but let's put the credit spread factor. I don't know. I really don't know how to say this and why the math works like this, but we'll start with a 1 and just multiply that by 1 plus the credit spread. Okay. Shift Control 1, Shift Control R. Okay, and then if we want to see how much the implied loss is. Okay, we can take this divided by 1.04. That's how much is cash flow without spread. Okay, oops. Okay, and then we can put the, now to demonstrate that that really works, let's put a verification. If we put this one and then just put in the credit spread, okay, and then we put IRR on cash flow without with loss. I would put it like that, equal IRR, and we get exactly our risk-free rate. So we've demonstrated that the difference, this is the cash flow you would get after the loss, because you've reflected the credit spread. This is the cash flow you get. So the loss from the implied loss from the credit spread is the difference. Okay, so in the first year, it's not a big difference. This minus that. Here's the problem. Because of IRRs and because of compounding, gets to be a big number. By this time, it's a big percent. We can put percent of cash flow. So in the first year, well, it's like taking a loss of this, and then by the last year, it's a much bigger loss. It's 34%, and we better put an if on this one. Okay. And now that we could get the PV of the loss, I think that's, for me, that's, and I'm going to use the risk-free rate. So the PV of the loss is NPV at the risk-free rate of the loss, and then PV of loss compared to the debt, we could take that PV of the loss and divide it by the debt and get that 22% loss. We could also get the levelized loss, and to do that we need to first put a PV factor. I don't think we have one of those yet. 1 divided by 1 plus, now suppose we could use this one. I'm going to use the risk-free rate for levelizing. You could argue to use the entire rate, but okay, and that's just a weighted average, so then we put weighting. Okay, and that's the this one divided by the sum of the line. Okay, shift control 1, shift control R, and then the levelized loss per year is some product of this versus the loss, which is 10, and as percent of cash flow. I guess we could take this loss as a percent of the cash flow, and then we have a 7% default probability from 4% credit spread, a loss probability, not if you have a recovery rate or 1 minus the loss given default, you'd have a lot less. So, and I'm going to make another video of going through the PD and the LGD and all this stuff, Shift Control C. But this, I think, for me, the mathematics I don't think are in question. And the big deal is this one, just how much of a loss you get relative to the this one. Why did I do something wrong with this, by the way? That sums to 1. There's that. That seems to be way too close to the... Just a minute. Okay, I saw my mistake. I should have taken this thing and just switched it off later. So we got a 18% levelized amount. Okay, so we get a PV of loss. That means my PV factor had gone to the whole thing of 22% levelized loss of, this is not probability of loss, this is probability of this is not probability of default, this is probability of default including at 100% loss given default. So if there was a half a chance of getting it back, the probability of default would be double this. This just shows you how big. And if we have let's put a 20-year debt in, then look how much the loss goes up to, 43%. And if we have a 5% credit spread on a 20-year debt, we get a 55% probability. We can reduce the, that's the same thing as saying there's a 55% chance in present value terms that you're going to lose. Now, if it's 3%, it's still 31%. If it's 1.5%, by the end of 20 years, it's 15. In 15 years, it's 11. So there's a big, this is all stated in terms of present value, and the reason that the numbers are so big, if it's 1 year, it's just the regular old credit spread. There's no big deal. If it's 2 years, you have a higher loss, and if it's 5 years, you have a higher loss, but it doesn't get that high until you start getting up to 10, and then it starts rocketing up. And if you have 5, if we have 1, 2, 10, maybe let's do a quick data table on this. So let's just put the tenor 1 plus 1, okay, and then we'll put that on here, okay, and then we'll put the, of course we can't make a graph, which I hate, probability of this, no, that's going to be here, and then we'll put our credit spread of 1.5%, let's make it 3%, 5%, which I've seen, 7%, that would start to get outrageous if it's more than that. Shift Control right arrow, so you can put Shift Control space there too, and then you go to data and what if analysis and data table, and the row input is the credit spread and the column input is the tenor, and we need to go and calculate the sheet. This time wasn't so bad. and Shift Control P, and if I could get rid of this somehow, I could have a nice graph. And since I can't, I'm going to do the damn thing. Like this. Control D, Control R, and then let's make this graph, and then alternate F1, and you can see how the kind of would a line be better like this here, you think? I don't know, but you can see maybe that when the credit spread is high and the debt goes high, you get this magnification, and you get these incredibly high implied probabilities of default. And when you start putting these in Africa, that's one of the crimes. It's the crime on the debt side. Talk about the crime on the equity side later, but I don't know, you could say, oh, it's almost better to have short-term debt. I'm skeptical of that. I haven't really thought through that one yet, but well, if you could refinance that debt at reasonable rates in the next go round, maybe it would be okay. We could do a whole kind of analysis of that, but I'm not ready to do that. Okay, so there's our problem. Look at that. We get to almost 100% assumption that you're going to lose. Basically, if you get a credit spread of 107%, see how we can interpret that. You would, I guess you can't lose relative to the risk-free rate. That's what it seems to be saying. You can lose 100% of your present value of your debt, and still you've earned that high credit spread. Now, of course, if you lose it all here, right, we'd have to think about it. Then it could get worse. But that just shows you some of the kind of mathematics and the games of the IRR. Remember, this is not just saying this is the present value of the loss. This is not the accumulated loss in some kind of nominal terms. So just think about it. If you earn 7% and made 7% in the first year on 1,000, you've already kind of made 70 back. And how many years of that 70 back do you have to make to kind of make a break even? Well, I don't know. I'm not getting very far with explaining that one. But that's the first kind of issue with just risk premiums. Okay? So, I don't know what to say about this, but if you're having to pay those kind of credit spreads, you want some kind of other, you almost want some kind of other debt in there, really. Okay, enough of that one.